YouTube.com/what's a mortgage. We're about to go on live right now. So don't forget to log in. Did you know that 6 out of every 10 people that apply for a mortgage either don't qualify or they don't qualify for the home that they want? Imagine the perfect down payment assistance program comes out, or interest rates drop, or prices come down, or a family member decides to give you the home at a discount, or your landlord sells you the home at a discount. But guess what? You don't qualify. And one of the main reasons why most people don't qualify for a home is because their credit is not ready. Tonight, we are going to go over how to what's the title? How credit is used to qualify to buy a mortgage. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Hit that subscribe or notification button so you are notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 8 p.m. We post content daily on TikTok and Instagram. So if you're not following us on other platforms, please go ahead and do so. Also, if this video brings you any value, like this video and tag someone that you know that would find this information useful. So tonight, we're going to break down how to prepare your credit to buy a home. Of course, in California, the heavens open and Jesus reached his hand down and dropped the Dream for All program. If you don't know what that is, in California, they loaned you 20% down to qualify to buy a home. And of course, people bum rushed all the loan officers to apply. And over the half of the people that went to apply didn't qualify because their credit score wasn't where it needs to be, or they had way too much debt and they didn't qualify for the home they want. That's not going to be you. If you plan on buying a home in 2023 or in the future, tonight we are going to teach you how to prepare your credit to buy a home, right? Instagram, go on youtube.com/what's a mortgage. We're going to show you how to qualify your credit to buy a home. All right. Facebook and YouTube people, get ready. Okay, so how credit is used to qualify to buy. Just understand that there's two factors. Two things you want to think about when you're trying to use your credit to buy a home, okay? Credit score, a grade that shows the lender that your ability to pay back debt, okay? That's what the score does. And the second factor, monthly credit debt, shows the lender how much debt you have to pay monthly, excluding the mortgage payment you will be getting, okay? So those are the two main factors you want to prepare yourself when you're gonna buy a home. The score lets the lender know your behavior, your habits of paying back the mortgage. Your credit liability lets the lender know how much you can afford because you have other obligations. And we're gonna go over the obligation that the lender looks at, okay? But before we get into that, the one thing that you wanna pay attention to is the public records. When you are looking at your credit report, you want to pay attention to the public records, okay? So I'm talking about bankruptcies here. Chapter 7, Chapter 11, Chapter 13, short sales, and foreclosures, okay? Depending on the program you're going with, you want to make sure you fall under the right category. If you're going with a VA loan, you got 2 years, Chapter 7, 2 years, Chapter 11, Chapter 13, okay, after 1 year of making your payments on time. Short sale, 2 years, foreclosure, 2 years. Government loans, FHA, USDA, 2 years, Chapter 7, 2 years, Chapter 11, Chapter 13, same thing, as long as you make 12 payments on time. Short sale, 3 year, foreclosure, 3 years. See, they're more lenient with government loans. Conventional loans, 4 year plus, 7, 4 year plus, 11, 2 year plus, Chapter 13. Short sales, 4 year plus, foreclosure, 7 year plus. So if you fall under these categories, you want to look first because, of course, if you're a VA, you might have to wait it out a bit. If you have a specific bankruptcy, you might have to go FHA over conventional. So that's why it's important that you look at your public records. Typically, it's going to be on the bottom of your credit score. When you run credit, you'll see it at the bottom. So you want to go to that right away if you fall under any of these categories before looking at the score, before looking at your debts. You want to make sure those liabilities on public records have matured. If you haven't, it doesn't matter. You can have smoking credit or no debt. You will not qualify to buy a home. Okay. So when you look at the public records, it gives you time in case you do have a short sale, foreclosure, or a bankruptcy to start preparing your credit. I see a lot of people file for bankruptcy, and when the time is up, they apply for a mortgage and they don't qualify. If you know you have 2 years or 4 years, start building new credit. Don't wait until you're 2 years up or 4 years. There are credit cards. There are cars you can get where right after BK, you can get a credit card. Right after BK, you can still buy a car. Start building that credit right away. The longer, the stronger the credit history, the higher chance you are redeeming yourself, and then you can buy a house a lot easier. I saw that on a lot of credit reports recently where, you know, the BK was up, the short sale, the foreclosure, and they go and apply. They have enough money. They don't have a lot of debt. They have good credit score, but they don't have enough strong liability and history because they waited too long to build credit. Okay, so make sure you look at the public record. Let's look at the most important facts about your credit score. Okay, so when you're looking at your credit score, they're grading your behavior of paying back debt. Lenders pull 3 scores from 3 different credit bureaus to grade your credit: Experian, TransUnion, and Equifax. You need all 3. Understand the difference between each credit scoring model. And this is where people mistake, and they look at their credit score and they get excited. And when they talk to a lender, it's not the score that they're looking for or the right score to qualify. So understand the difference between each scoring model. Okay. There's FICO Score 8 for credit cards and student loans. There's FICO Auto Scores. That's for your car loan. There's Vantage Score 3 for Credit Karma. And there's FICO Score 2, 4, and 5. And that's for mortgages. So make sure you use the right model to run your credit when getting a mortgage. Either talk to a lender and have them run your credit, or go to myfico.com and pay for it. People love to show me their app on what their credit score is. And when they see the house they love, they run the credit and the FICO drops. Or it missed a liability, and now that liability is going to populate on your score, on your report, and now your debt to income ratio is too high. So make sure, if you are serious about home ownership, either go call a lender and have them run the score, or whoever you're paying to run your credit, make sure they run FICO Score 2, 4, and 5. If they don't, you're going to be in some deep trouble. I've seen credit scores low 700s, high 600s, and when the lender runs it, it's 640, 620. They still qualify, but it's not a payment that they're in love with. And by the time they fix their credit to qualify for the home they want, guess what? They're shopped out of the market. That's why you want to start working on your credit ahead of time, okay? So those are important factors. So you want to work on your credit, this is what your credit score is made of. You've probably seen this graph online. Pretty accurate, not gonna lie, okay? What makes up your credit score? Your credit score ranges between 300 to 850, okay? Amount owed makes up 30% of your credit. New credit makes up 10%. Length of credit, 15%. Mixed credit, 10%. Sorry. Mixed credit, 10%. New credit, 10%. And on-time payment history makes up 35% of your credit. So when you're looking at your overall credit report, this is how your credit score is determined. So of course, on-time payments is the most important thing to do. Second is going to be how much do you owe. That's called your credit utilization. When you have a low utilization and on-time payments, you will have a higher score. Utilization, so let's say you owe $1,000, you have $1,000 limit. You want to keep it under $200 to $300 a month. When you start getting in the 400s, 500s and the 40, 50, 60%, it's going to bring down your credit score. Okay. So if you're thinking about buying a home, you want to look at your liabilities and keep it low, okay? As low as you can with on-time payment histories to keep up the score, okay? New credit makes up 10%. So that is inquiries as well. Also, length of credit makes up 15%. So you want to make sure you have credit for a long period of time, okay? And then, of course, mixed credit. What's mixed credit? So there's 4 types of credit. There's revolving debt, installment debt, and then there's mortgage debt. Most people will have revolving and installment. Mortgage debt, because there is a revolving and there's an installment. The 4th type of trade line is going to be derogatories. That's the only one you don't want. So when they're looking at your credit, they're looking at a mix of credit cards, installment debt. They want to see you have a behavior to close out a debt. They want to see a behavior that you've made payments on time and you've had the credit card for a long period of time. Okay? And credit history makes up 15%. So when you pay down a credit card or pay it off, make sure they don't close out that credit card. When they close out that credit card, you lose that history. That history makes up 15%. So if you have a car that you close out, it's going to hurt your credit just a little bit, okay? If you get a new car, you make 3 payments on time, credit history starts building up again. So that's why it's important to talk to a lender, get your credit ran, so you know, okay, I can pay off this car. If I do, when I get my new car, let me make 3 payments on time. Or make sure you don't get your credit cards closed out. Let's say you have a credit card that you haven't used in like a year. If they close it out, but you've used it in the past and you had good history, it closes out that history. So understand that when you are preparing to buy a home, right, you want to look at on-time payments, amount owed, history, make sure you've had that card for a long period of time, okay, inquiries, new credit, and last but not least, mixed credit. I'm not too concerned with mixed credit. I'm concerned with on-time payment, history of credit, and amount owed, utilization. Those 3 really dictate it. If you have busted up credit and you're trying to delete collections and charge-offs, cool, work on that, but don't just focus your energy on that. Focus on getting new credit cards right away or adding yourself as an authorized user. Remember, the 3 that make up the most, history, on-time payments, and utilization. Start doing things to offset your boo-boo credit or your issues that you had in the past. Start focusing on new credit, right? You ever get in a fight with your spouse? You want to talk about the old things over and over again, rehash it, and explain yourself? No. You want to start talking about new things, right? Oh, baby, just go here. Let's set an event to go here. Start building new rapport with your spouse. Same thing, start building new rapport with new credit. So you start building up that credit score, right? So here's the process. This is what I want you to do. If you are serious about home ownership, part 1, reach out to a lender, okay? You can do a hard credit pull if you're like ready to rock and roll and you think you got some like 800 credit score, which I see a lot of you guys messaging, or do a soft mortgage credit pull. Run a soft pull, okay? Part 2, make sure the lender pulls all 3 bureaus, but if they do a soft, they can do 1 or 2 bureaus, okay? You might not need all 3. 2 is enough for you to start working on things. And then, of course, the lender's going to use the middle score if you do a hard pull. Some companies are doing soft pulls on all 3 scores, but every lender's a little different. But if you get 3 scores on a hard one, just know that the lender's going to use the middle score, okay? So make sure you follow these steps. Step 1, you got to talk to a lender and pull it. But if you're not ready to talk to a lender, you can go to myfico.com and do a soft mortgage credit pull. They'll pull FICO score 2, 4, and 5. If you want to go somewhere else, just make sure they're pulling FICO score 2, 4, and 5. In the future, they might change the credit score model, but today in 2023, they're still using FICO score 2, 4, and 5. Okay. Once you get your score, you know what you need to work on. And then number 3, okay, what score they use? The middle score. So if you pull all 3, you know which score is affecting what points. So you know, okay, I need to bump up this score so I can get the middle score higher. All right. So once you do that, you're ready to rock and roll. But let's say you're buying a home not alone. You're buying it with a spouse. Same thing, or someone who's going to help you qualify. They have them run credit, do the same thing. Just understand the lender is going to use the middle score of the lowest person. So if borrower 1 has a 600, 700, 800, borrower 2 has 650, 750, and 850, they're going to use the 700 score to grade your credit to give you a loan. So if you're buying a home and the other person doesn't have great credit, they're the ones pulling you down. to get a higher rate or program that you might not want to go through. So it's important that you be prepared ahead of time. You don't even understand when this dream program dropped in California, when they were going to loan you the 20% down, people would apply. There was one or two people in every group where the other person's credit score anchored them away from cheaper PMI or away from qualifying. Okay, so it's important that you do this prep work way ahead of time. People spend so much energy on Christmas parties, Christmas pictures, birthday parties, dessert tables. Why can't they spend this type of energy on qualifying for the biggest investment they're going to make in their lives, which is home ownership, right? So let's talk about the scores that you need. The reason why we want to do this, we want to have the right score, right? If this brings you value, do me a huge favor. Please leave me a comment on the bottom. Let me know that this brings you value. Give me a little heart sign, right? Give me a little thumbs up, or tag a family member or friend that you know you're going to buy with. Hey, get your boo-boo, get your butt in gear and start working on that credit, all right? So if you go conventional, it's between 620 to 760. You want to make sure you have a 720 credit score or better if you're going to go with conventional. Government loans, 580 to 680, which I've heard you can go lower, but all you need is a 660, and you are money, okay? Jumbo loans, 680 to 780. All you need is a 740, and you're maximizing the best deal, right? But as you guys know, this is May 2023. With FHFA releasing the new loan level pricing adjustments, if you're doing 10% down or less, the FHA payment with a 660 credit score will be better or the same as if you had a 720, 740 going FHA, okay? If you go conventional these days, you would need 10% down or more, or 15% down or more to make conventional worth it. Even with the higher rate, you get the cheaper PMI, it might be worth it. 10% down or less, FHA is going to have the same payment, so you don't need to chase that 730, 740, 720, 700, 660. You are in the bag, fam, all right? Hopefully that helps you out. So now let's talk about, of course, now we already talked about your credit score, which is important. That's why you want to talk to a lender, find out the score, so you know how to make adjustments to improve the score, right? Check public records first. Make sure you don't got BK, short sale, or foreclosures that haven't aged yet. Okay, once you've done that, check the score so you know that you're going to qualify for something. And last but not least, you want to check your debts and liabilities. How monthly credit debts can affect buying a home. It changes up your buying power. And I see this happened a lot, right? Score was one thing, but of course people, I want to buy this home. And all of a sudden they co-sign, or they got a new car, they got a student loan. Something happened. They went out and they bought a Bowflex because they saw an ad for a Bowflex, and they went out and they got this Bowflex, and now they don't qualify for the home they want. So understand that monthly credit debts affect buying a home, okay? Now let's recap on debt to income ratio. So most lenders will let you go to a 50% debt to income ratio. So if you made $10,000 in gross income, your max mortgage payment and all your debts, you're going to live on just top ramen, can't surpass $5,000, 50%. So take your monthly gross income, times it by 50%. Most likely you'll live on top ramen unless you have someone who's helping you make the payments that's not going to be on the loan. Okay? So here's an example. So let's say you have a monthly gross income of $10,000 a month. If you have $1,000 in debt, you can only afford a $4,000 mortgage. If you have $1,500 in debt, you can only afford a $3,500 payment. If you have $2,000 a month in debt, you can only qualify for a $3,000 mortgage. And if you have $2,500 a month in debt, you can only qualify for a $2,500 payment. So as you can see, the more debt you have, the less buying power you have. So that's why if you're going to buy a house in 2023 or in the future, once you look at your public records, you check your score, you want to minimize your debt unless you make that much more in income, okay? Here's a rule of thumb, depending where rates are at. I gave you this cheat sheet here, all right? So typically, this is for 10% down or less to qualify for $50,000 more home. Most people qualify shy of the home that they want for about $50,000 to $100,000. So let's say today rates are 3%. If rates are 3% for every $340 a month, that's $50,000 in buying power. At 4% interest rate, 370. At 5% interest rate, 400. And 6% right now, because rates are in the sixes right now, about $430 a month. So if you have an insane car payment, I had a guy, check this out. He had 2 car payments for $1,800 a month. I think this is when the rates are like in the 4%. Okay, so he lost over $250,000 of buying power. I was like, almost, no, sorry, oh, 200 grand of buying power, 200 grand of buying power, $200,000 of buying power. Of course, he had a really nice BMW, and I think he had a nice Cadillac, and he lost all his buying power. He would not accept that he can qualify for only like a $600,000 home back then, because his cars look way nicer than the home he could afford. But remember, cars depreciate. Home ownership is not for everybody, but if you are gonna buy a home, minimize your debt so you increase your buying power. If you don't care about owning a home, go YOLO, get the car of your dreams. It's going to help you with your confidence or help you get more business. But if you do want to become a homeowner, unless you ball out of control, you might need to pump your brakes and get a car a little bit less expensive so you can get a home that appreciates. Imagine you buy a home for 600 grand. Even though ups and downs, homes appreciate, let's say 3% a year. Every year, that home's going to get you 18 grand in equity. So a little sacrifice of a nice car in the beginning of your career of life can help you at the bigger picture. So understand, once you know your public records, I like to repeat myself, once you know your score, look at your debt and attack it so you can put yourself in a good position. This is May 2023. Inflation's at 5%. Okay, 5.6 if you're not counting core. And inflation is going to come back down, right? They are pulling money out of the economy. And they're letting their balance sheet run off. They are hiking rates. People are losing jobs and unemployment is trickling up. The job market is weakening. Rates will pull back. I believe this summer, but let's say I'm wrong and it's at the end of the year or beginning of the year. This is the time to prepare yourself. So when rates pull back, you're in the right position to buy a home. Do not use this time and do not let this time pass and not find a way to look at your public records, maximize your score, and eliminate as much debt as you can, because when rates drop, you want to be at the right place at the right time and qualify for the home you want, right? So this is what you want to do. We want to look at your debts. These are the debts they're going to look at, okay, when you're looking at your credit report. So credit debts, they're going to count against you. So you want to focus on this. You have revolving debt, installment debt, mortgage debt, okay, if you are going to buy another home, collections. Don't include charge-offs or medical collections, just regular collection. Court-ordered debt, alimony, child support, if you lost any lawsuits, or government debt, the IRS, okay? So if you have court-ordered or government ordered debt that might not show up on your credit report, you might think, I might not need to add it. Trust me, lenders are smart. They can pull and find out if you owe alimony or child support. Okay, they might not find out if you owe court ordered, but IRS, if it's not on your credit report, there's a chance they might not catch it. But alimony and child support, they will catch that. They will find out your pay stubs, or they run a program and they'll catch if you owe. Because now you have that payment that you owe. How can you afford the mortgage payment? They're going to lend you hundreds of thousands of dollars. You want to make sure your credit is in the right place. If you have these affairs with child support alimony, let's say you don't make as much as you used to, go back to court, negotiate the child support and alimony. Okay, IRS. I don't think you can negotiate child support, but alimony you can. Okay, IRS payments. I think you can negotiate child support. IRS payments. Don't let the IRS come calling you. Call the IRS. The sooner you call the IRS, the lower the payment you can negotiate. If they come knocking on your door, they're going to give you a payment you don't like. And remember, we went over it. Right now, where rates are at 6%, $430 a month will eliminate $50,000 of buying power. And you want to make sure you maximize that buying power, especially the way inflation's going and we don't have a lot of inventory. The only thing holding back demand right now from unleashing the Kraken is today's rates. Once this inflation comes down, they're going to pivot because they got to get businesses drumming up again. And when they do, you want to make sure those debts are gone or they minimize, or you figure out, add a co-signer or have someone else live with you who's going to help you qualify to buy. Okay. So that's what I recommend. All right. So know the debts. Also, verify your monthly credit debts, right? Have the lender run it. You can use, if you're not ready to buy, use Credit Karma. Check your utilization and verify your limits and balance. If you know you got an 800 credit score and you don't want to talk to a lender, that's fine. Go to Credit Karma. Know where you stand. Okay? If you have a joint account, don't hit it twice. If it's a spouse, if you have the car on both accounts, don't hit it twice. If you're an authorized user, you don't have to count that monthly payment on your debt to income ratio either. So remember that if someone added you as an authorized user, you don't have to count that monthly debt. All right. So once you find out all the monthly debts, either talk to a lender or go to Credit Karma or find a way to pull your credit. Right. If you're not ready to talk to a lender, go to myfico.com. At least it's FICO score 2, 4, and 5, so you know where you stand. Write down a list of all your debts. Okay. Tally up all your monthly debts. If you have a collection, they look at it a little different. We're going to go over that in a second. Okay. If you have a collection, they're going to look at it a little different. But tally up your monthly debts and subtract that. Like, take your monthly gross income, times it by 50%, and subtract your monthly debts. Whatever's left is your max mortgage payment. And if you're not happy with that payment or something that won't get you the home that you want, start eliminating some debt. Since you were preparing ahead of time because you watch What's a Mortgage, you'll be ready in no time. Okay. So now let's look at the debt rules. Are we on the debt rules? Match it up to your match up to your DTI really quick. Let's look at this. So conventional loan, remember you have 50%. Same recap as earlier. If you want to be conservative, you can go 45 or 43%. Conventional, here's 50%. Government loan, 55% is the max, okay? So conventional, let's recap it one more time. $10,000 a month in gross income, $5,000 a month of debt, right? If you have $1,000 a month in debt, that's $4,000 in mortgage. $1,500, $3,500. $2,000 a month in debt, $3,000 mortgage. $2,500 a month in debt, $2,500 mortgage. Now, government loans, $1,500 a month in debt, $4,000 mortgage. $2,000 a month in debt, $3,500 mortgage. $2,500 a month in debt, $3,000 mortgage. $3,000 a month in debt, $2,500 mortgage. So government loans are a little more flexible when it comes to debt, right? Now let's go over some rules. Okay, if you want more of these rules, if you want details on these rules, you can go to whatsamortgage.com and download our ultimate mortgage guide. We go in depth on these rules. Okay, let's put it up on the screen. I'll read it and I'll explain it line by line. Here are the rules you want to know. Okay, for credit rules that will tally up your debt. Whatever monthly debt is on your credit report, you want to add that payment to your monthly debt to income ratio. If you have a collection without a payment, you can take the balance times it by 5%. That is the payment they add to your debt to income ratio. Okay. So if you have a $500 credit card or a $500 collection, that's $25 a month. Student loans without a payment. If you have a student loan without a payment, if it's in deferment or forbearance, you take the balance, you times it by 1%. Okay. If it's in income-based repayment and you're going with a conventional loan or FHA loan, they take the balance, they either times it by 0.5%, or if there's no payment, they add zero payment. Every lender is going to judge that a little different. If you do have a student loan, it's in income-based repayment, and you want to talk to a lender, give them a call ahead of time, or you can reach out. If you co-sign for anybody, okay, remember, make sure you're the co-signer and not the main. If you are the main, on an FHA, you can't omit it. On conventional, you can omit it, but you have to be the co, and the other person has to show proof they've made 12 payments. If you co-sign for a mortgage, you make sure you don't live in the house, make sure you don't write off in the interest, and make sure the other person makes 12 payments before you can omit it. Installment debts. If it's a car and it's a lease, it's not an installment debt. If you have another installment debt that has an ending to it, like a car or a Bowflex, with less than 10 payments left, you can omit it on a conventional loan. On an FHA, on top of less than 10 months, it has to be less than 5% of your income. All right? So if it's not less than 5% of your income, then you cannot omit the debt. So if you make 5 grand a month gross and the debt's over 250, you cannot omit it on an FHA. On convention, you can do that less than 10 months. Okay. If you want details of these rules, go to whatsumortgage.com and you can download it, right? Hopefully you found this information useful. So that's how you prepare to buy a home. Don't be like the 60% of people who qualify where you don't qualify or you don't qualify for the home you want. So, like I said, you can go to whatsumortgage.com, download our ultimate mortgage guide. Now you are prepared to be a homeowner, right? If this information helps you out, do me a huge favor. Please follow the page. If you already are following the page, please do me a huge favor. Like this video and tag someone in it that you know will find this information useful, right? So if you do need to get a hold of me, here's our number, 714-790-9697. You can give us a call or send us a text message if you're a shy guy, shy girl, or shy person, and we will jump in and help you out and help you prepare your credit to make the biggest investment you are going to make in your life, home ownership, right? Let's go some Q&A. All right, guys. Was that useful, guys? Let me know. Keen, why no share button? Oh, hopefully there's a share button.
That's on YouTube. It should be below the video player.
Below the video player. What's going on? Thank you, Keen. Thank you, Keen. David Daniel, 2010. Everyone went FHA to buy again because of the bankruptcies of 08 crisis. Brian Price, I have a 6 years from bankruptcy. I have a 716 FICO and about 2 years of credit build-up. What type of loan should I get? If it's 6 years, I would go, right now, 716, I would go FHA to get the best deal. Okay, 716, FHA will get you the best deal right now. 716, if you go conventional, you want to make sure you have 15% down or more because the monthly PMI will be expensive. Especially they just cut the monthly MIP on FHA loan. So under 760, under 10% down, go FHA for the cheaper payment. Yes, your balance can go up because they add on the upfront MIP on FHA, but overall, if you're chasing the cheaper payment, FHA will have the cheaper payment, okay? Import Sylvia, what's up with the BS of good credit? Yes, good credit, people, it sucks, okay? I understand if you want to improve buying power for people with lower credit because delinquency rates are down, I get it. But don't penalize people with good credit. You can talk to Sandra Thompson, all right? She's the head of FHFA. She's justifying saying that because of high risk. I don't know, okay? I went over mixed credit. All right, went over that, James. Is there a difference in rate if my credit score is 780 to 800? So, Ryan James, if you have a 760 or above, your deal's gonna be the same, okay? But 780, 800, or 780 and up, PMI will be cheaper if you really have a 780 or 800. Okay, I ran credit for a good amount of people, and I say it is very low. Not saying that you don't, Ryan. Has popping credit, but you have 780, you're solid. Okay. But bigger down payments do increase your rate, though. That's the one thing I don't like. Okay. Told me there's a cushion. Lord Loco, all this is interesting. Buying a home right now. They accepted our offer. Congratulations, Lord Loco got an accepted offer. Your son is in the Marine. 775. Go FH. Go VA. Go VA. Mary Carmen, my son is in the Marines. He wants to purchase these credits. Their credit score is 775 plus. What is the better to buy? Temecula, Marietta, Oceanside, Fallbrook, better in price now, but that will get equity faster. Mary Carmen, it depends on the price point. What I would do is if you send me a bunch of zip codes, I can pretty much tell you, looking at the zip codes, because every area is going to be a little different. Real estate is so local. It can be zip code based, even area based. So have your son send me the zip codes and I'll look it up and I'll tell you where he's going to have the best bang for his buck, okay? Karina, when you get married, are you obligated to pull both credits? If you are going FHA in a community state, Karina, then you have to pull both credits. Even if the other spouse is not going to be on the loan, you have to add their liabilities, okay? David Daniel, VA, there's a loophole around it, but DM me for details. Ryan at the score. Oh, thank you for answering that, David. Thank you for answering that, Andrew. VA has a rule. You don't have to run, if you run the spouse's credit, You want to add them as long as the spouse has a job that can cover their own debts. You don't have to add them. There's a rule around it. Okay. Jose Navarro. Okay, what if score is good, but how much do I need to make to qualify for a 450 home? Jose, we need to look at your monthly debts, also your down payment. Please send me a DM or give us a call. Here's our number again: 714-790-9697. All right, fam. Thank you, Jose. Thank you, Andrew. Jamie or Jaime or Jamie. I wish I knew all of this when I bought my first home. Oh, you're welcome. Thank you so much. What loan fine you for paying off early? You can pay off a loan early. No one's gonna fine you, Karina. Okay, those prepayment penalties are gone. For FHA, can I exclude my wife loan? You can exclude your wife, but you have to count her monthly liabilities, Ryan, if you're in a community state. Okay. See here, can you pay off your loan? They are that early. What are charge off? What are charge offs considered? So when you look at your credit report, it'll tell you if it's a charge off. That means the bank or whoever your creditor is has write off as a loss. They've already reported with the IRS. Collections, they're still hoping they're going to collect or they sold the debt off, right? Hopefully that helps you out. See, we answered that. Not a question, but I just want to thank you for sharing your knowledge. I'm looking to buying a house towards the end of this year. I'm learning so much from you. Thank you so much, Kat. See, Ryan, good answer. Oh, dude, I love that you guys are answering each other's questions in here. Man, I really love this community. End of the day, if you use another lender, I'm cool with that. Just help each other out. Help each other solve these questions or answer these questions. Because at the end of the day, I might miss a question. So if you know the answer, jump in, okay? If you make 100 grand, it all depends, Nikki. It all depends on where you're buying, the down payment, and the property tax. Let's say in New Jersey and in Texas, the property taxes are higher, so you're going to qualify for less. But homes probably cost less than they would in California. So send me a DM, okay? If you eliminate $500 a month in debt, and today you're going to qualify. It's Ryan. It's an extra more than $50,000 in buying power. A little bit more, not that much. Remember, 430 right now. All right. Can you specify collection, charge off, and medical expenses? What's the best? What's best to eliminate? Thank you in advance. Sunset View. A collection is when a creditor still feels they can collect a payment from you. A charge off, they've already reported at the IRS. They've already taken the L on it. A medical collection, lenders don't even count that. It does affect your score, but they don't even count that. They don't ask you to pay it off. Collections, though, if it's over a certain percentage, they'll ask you to pay it off, okay? Hopefully that helps you out. See here, okay, 50%. Brian, if you want to go over qualifying, give us a call, 714-790-9697, okay? Hopefully that helps you out. See here, Karina answered that. Question, I have 2 hospital collections that went to collection. Should I pay it off? If you have a medical collection, it affects your score, but if they're old, leave it alone. Do not mess with it, okay? If it's new, they're willing to settle. Medical collections are a little bit easier to delete on a credit report. Talk to a credit repair person because just how it's set up, a little bit easier to fight. If it's old, leave it alone because it's not affecting your score anymore. It's just on there, but the lender's not going to ask you to pay it off. All right, hopefully that helps you out. Michael Miller, my daughter is on disability. Can we use her check to qualify? If it's permanent disability, Michael, then yes. Okay, permanent disability. What is PMI? Private mortgage insurance. So Gerber, when you put less than 20% down on a conventional loan, you have private mortgage insurance. So when you have enough equity, you can remove it. On FHA, it's called MIP, mortgage insurance premium. That is permanent unless you refinance from FHA to conventional, okay? Thank you so much, Jackie. Send me a DM. Public record area says none. Does this affect positive? If Araceli, if it says none, you're good to go, okay? If you have child support, alimony, or court order, just make sure it's not on your paycheck stub. Alimony and child support, they probably catch it somehow. They run a report, they can catch it. But IRS payments, if it's not on your credit report, it's hard for them to catch. And when you lay it off, okay, see here, we make 52,000. Michael, send me a DM. Send me a DM, okay? And I'll or message me at 714-790-96. Sorry, 714. What's our phone number again? I forgot. I'm going blank right now. 714-790-9697. Okay. Yes, Brian, we do work Colorado. Send us a DM. Thank you, Selena. How long does it take to fund a loan after signing loan docs, waiting patiently? If you wired your money, it should fund within 72 hours unless something's holding up, but 72 hours, okay? Oscar, what up, fam? Hell, nah, fam. They used to use. They used to use. They need to use you if they're learning from you. Plus, your best. You guys got me my first home. Oscar Gonzalez, thank you so much. You know, I would love people to use me, but in the day, you know, we're here to provide advice. People like you, Oscar, reach out and use us, and that helps us tremendously in your referrals. But in the day, don't feel pressure. If you have another lender you want to use, I just want you to just make good decisions. Prepare yourself to buy a home is the most important thing for me. Okay, more people buy a home, it drives up my home value. So just buy. I'm kidding. But yes, I'm kidding, but not really. For medical expenses, what's the certain percentage? Medical collection, they don't count it against you, so it doesn't really matter. Collections, though, anything over $2,500, they're gonna count you. They're gonna want you to pay down under $1,000. Anything over over $2,500, they're gonna want you to pay down under $1,000 if you don't want it to be counted against you. Okay. What if I'm currently renting 1 year lease? Is there a backdoor to purchasing a home without paying to break the lease? Brandon, that's between you and your landlord. There's no way around that, fam, that I know. Thank you so much, Chris. All right, guys, I really appreciate everyone who commented, who liked, who stuck around. If you're not following by now on YouTube, please follow me. Also, it's going to be coming up. Check it out in my Instagram stories. I have an email. I'm going to have a couple blogs come out. It's called The Successful American. Outside of mortgages, if you're going to buy a home or not buy a home, I'm going to make sure that I help you set the foundation of financial literacy so you are a successful American. So sign up for my blog. On Mondays, it will be The Successful American. I will look up and do my research. Where are the cheapest savings account? Like, did you know if you have over $250,000 and you don't care about making interest, don't put that money into your checking account or savings. Put it into a trading brokerage account. They can't use that money to reinvest it. So if the bank craps out, they can't. You're gonna get all that money back. So you put let's say you have 500 grand. They don't owe you only 250 max. They have to give you the whole thing. Right? Those are the things I'm gonna go over. Wednesdays will be a mortgage horror stories, where we're gonna go over all the things that people go through that are horrors about being a homeowner. Okay, and the things I don't want you to go through. And the last but not least, we're going to recap the week. Let's say you missed my morning market updates. You want to know if you should buy or refinance, or if a new program is going to hit the streets, that's going to give you a smoking deal. It's going to be on Friday. So look out for my weekly newsletter. So register for it. All right, guys? Thank you guys so much. And again, without you, there is no us. So thank you guys so much and have a great night. All right, guys?